Let's start with right shares. What does right shares means? Right is a right. See, a right share is a right given to existing shareholder. Existing shareholder to subscribe. Just a second. To subscribe to the new securities of the company at a discounted price. If the shareholders subscribe to the new securities issued by the company, then it is known as exercise of right. It should be treated as regular purchase. Okay, so firstly I want you all to please pause the video and copy this much first. I hope you all have paused the video and copied this much. Let's move on. If the shareholders does not subscribe to the new securities, it is called as let off right. Therefore, there is no accounting required. Okay, if the shareholder transfers a right to the third party to purchase the securities, it is called as renouncement of the right or sale of the right. In simple language, sale of the right. It should be treated as extraordinary income and should be directly transferred to profit and loss account credit side as per AS 13. This is given in AS 13 and I'm guiding you all over here because it was needed over here. In that accounting standard chapter there is no need of this part, so that's why there it was ignored and here it has been presented. Okay, so let's read right shares. Right share is a right given to the equity shareholders or the existing shareholders to subscribe to the new securities of the company at a discounted price. That means the company is giving you the right that purchase the securities at a discounted price. Okay. If the shareholder subscribe to the new security issued by the company, then it is known as exercising of the right. Okay. It should be treated as regular purchase. Okay, but at a discounted price. In the cost column you will write the discounted price. Simple. If the shareholders does not subscribe to the new securities, it is called as letting of right. Letting means let going, let leaving of the right. Therefore there is no accounting for that. Simple. If you are letting it go, there is no accounting for that. Okay. If the shareholders transfer a right to the third party to purchase the security, it is called as renouncement of right or sale of right. So what does this mean? You are been offered that if a 10 rupees face value shares is been sold in the market, but the company is selling you at 3 rupees, so that means 70% discount has been given to you. That means at 3 rupees you are purchasing one equity shares, but you have renounced your right to a third party, and you have asked him to pay you 2 rupees for each number of shares he is purchasing. That means you are not buying the shares from the company at 3 rupees, but you are selling the shares. You are selling a nominal right to a third party, and he is paying you 2 rupees for each share that he has been purchased. That means for him the purchase price will become 5 rupees. Okay, but the right that has been given to you of purchasing 3 rupees, you are letting it go. Okay, so that 2 rupees profit will directly go into profit and loss account. So it has been told over here, it should be treated as extraordinary income and should be directly transferred to the profit and loss account credit side as per AS 13. Quite simple. I hope I have not given time to copy. If I have given, again I am giving. Please pause the video and copy. Okay, now last part, dividend. Dividend income. So what does dividend mean? Dividend means at the year end the company declares the dividend. During the year the company declares the dividend at the annual general meeting that you will be studying in the company law paper 2. So in that you study it in detail. Now simple understanding, dividend is simply like interest only. The company gives you uh, you receive income of your holding the equity shares in the company, some benefit you are receiving. So that is, so you can take it as interest only, because at a certain specific rate is been declared in a AGM, and as per that rate you will be getting dividend. Okay, just like our debentures, we were having 8%, 10%, the rate of interest were fixed over there. Here the rate of interest is not fixed, because at every AGM the rate will be decided. Okay, so let's write, it is a return on investment made in shares. The treatment of dividend depends on the holding of the shares in the period for which dividend is being declared. So what does this second half means, we'll understand in detail now. The treatment of the dividend depends on the holding of the shares in the period of which dividend is being declared. So let us elaborate it and understand it down over here. If the shares are brought forward from the last year, that means the previous year, to the current year, to the current year, and on such shares dividend is paid. That means dividend you are receiving, that means dividend you all are receiving, then such dividend will be revenue sorry, my hands are paining, will be revenue income, that is, it will go in the income column. Here also you have to draw 3 columns: face value, income and cost. Okay, it will go in income column. Simple. If the shares are brought, that means purchased, brought in the current period, and on such dividend is declared, then such dividend will go in cost column, as it is capital revenue. Okay, this is quite self-explanatory. I've just written my explanation. So firstly, please pause the video and copy it off. After this, we'll solve the sums.